Hello, everyone. Welcome, and I'm glad that you're starting off your weekend with another episode of Investing Kev. We are on episode 33, and in today's video, I want to take a look at a few Chinese stocks under $10 that I think are deeply undervalued. Some of these stocks I already own, some of them I don't. This won't be an all-inclusive list. I repeat, it is not an all-inclusive list. I might make a part 2 video, so let me know in the comments if you would like to see a part 2. If you like this content, please help me out by liking this video for the YouTube algorithm so I can grow this channel. Subscribe if you want to see more content, and let me know in the comments what you think. As a reminder, there is risk in any investment out there, and this is no different. Many people would consider these stocks a high risk, high reward scenario, so you have to do your due diligence and you have to have conviction in buying these stocks. Just because I present these 5 stocks does not mean that they're going to do well. I am going off the information that I have at this point in time. Things are fluid and some of these stocks may never achieve their potential. If there is a market crash in 2022 or any other year, I don't really see these stocks growing much at all, as investors will likely shift their money towards defensive recession-proof stocks. If you want to reach out to me, I'm active on Twitter at InvestingKev, so swing by and shoot me a tweet. With all that being said, let's get started. Before we get into this, there are a lot of reasons why these stocks are undervalued compared to what they were earlier in the year. The biggest reason is the Chinese government ramping up their tech regulations, in which Chinese stocks took a massive beating during the summertime. A lot of fear, uncertainty, and doubt, and people not ever wanting to invest in China ever again, resulted in people closing out their positions and driving these stocks further down. It also didn't help that headlines sounded like the end times were near and that China was a country that you cannot invest in at all. There were other things such as the government reducing online gaming for kids, as well as trade war tensions, global affairs, and COVID all playing a role. Out of all the news related to China, I would definitely say the tech regulations and how it was presented to people was overblown, but people reacted the way they did. I made a video a few months ago talking about the Chinese tech regulations and why I'm not worried about it. If you haven't watched that, it's episode 19, Chinese data law and top 3 favorite Chinese stocks to buy. This video is situated in between the Uxin stock breakdown and analysis and ZTO Express stock breakdown and analysis. I will also have a video link in the description box below, as well as my Reddit post where I type out why I'm bullish on Chinese stocks. The first stock is DiDi, ticker DIDI. I came out with a video a few months ago on DiDi. Back then it was around $12 and it dropped even further and is currently $8. I don't own any shares of DiDi, but this is a stock that's been on my watch list for quite some time. I talked about data collection and privacy being necessary, as tech companies must be regulated for the protection of society. DiDi is currently hovering around $8, but the company is the Uber of China with over 490 million users. Right now their app isn't available for people to download. There have been some articles throughout the past few weeks that are saying that China's investigations on tech companies are wrapping up and that there's rumors that DiDi's apps may be reinstated. Also, DiDi may be pursuing a Hong Kong listing on the Hong Kong Stock Exchange, which from what I've read is what they were originally planning on doing before deciding to go with the New York Stock Exchange. Assuming DiDi has met the standards of the Chinese government and other governments overseas in the coming years, I think there's a lot of room to run in the years to come. The current catalyst for DiDi is if their app is going to be reinstated back in the app stores. In looking long term, this is an article from Motley Fool that came out back in August. Looking at 2025 to 2026, the Chinese government wants semi-autonomous vehicles to account for half of the country's new auto sales by 2025. Therefore, Chinese companies that are expanding their driverless networks, such as DiDi and Baidu, might receive significant support from government subsidies. The global ride-hailing market could still grow from 113 billion in 2020 to 230 billion by 2026, according to Motor Intelligence. If DiDi merely matches the company's estimated compound annual growth rate of 8.75% from 2021 to 2026, its revenues could rise from 30 billion this year to 46 billion in 2026. DiDi is currently trading at $8.12, and this is the first stock that I think is undervalued. The second stock is Fintech, ticker TIGR. I did a stock breakdown on Fintech a while back, so feel free to check that out. That is my most popular video ever on my channel, which is awesome to see, so thank you for that support. What I like about Fintech is the future of Chinese investors who are shifting away from real estate and diversifying into stocks long term. Fintech allows investors to invest in different stock markets around the world, from America to Hong Kong to Australia to London, and I really like their user interface and user experience. The future of financial technology, also known as fintech, excites me. Fintech has been beaten down, especially recently when China warned unlicensed online brokerages that they were breaking the law. In the article, it says that shares of the two firms had already tumbled since October 14th, when the official People's Daily said in an analysis on its website that Futu and Fintech face regulatory risks as China's new personal data privacy law takes effect on November 1st. I personally would have liked it if the company came out with a statement as quickly as possible, saying something like, "We are currently working towards being fully compliant with the Chinese government and their standards when it comes to data collection and privacy." They didn't, but it is what it is. And here's some news that came out today. Fintech Holdings Limited Singapore subsidiary receives official approval regarding securities trading and clearing in Singapore. With the official approval regarding securities trading and clearing in Singapore, the company expects to use these approvals to improve their user experience and services it offers to clients. Fintech is currently trading at around $6.81, and in my personal portfolio, I'm dollar cost averaging as much as I can into this stock. This is a stock that I'm personally holding long term on my portfolio. The third stock is Tencent Music, ticker TME. Just last weekend, I came out with a video on my 7-step process on how I evaluate stocks, and I use Tencent Music as an example. I currently do not own the stock, but as time has gone on, I'm really drawn to Tencent Music and will likely initiate a position before the end of the year or early next year. In my opinion, what Tencent Music offers is so much more than what Spotify offers. Looking at this article back in December 2020, social media, not streaming, is the music industry's future. Music streaming subscriptions contribute 8.5 billion a year to the record business, but the biggest future growth may lie in social media, gaming, live streaming, and fitness. This article talks about Warner Music Group. Warner generated over $3.8 billion in recorded music revenues in the last year, with some 63% of that coming from the likes of Spotify, Apple Music, and YouTube. But Cooper made an oddly under-the-radar revelation to analysts when Warner released its latest financials on November 23rd. With an expanding number of partnerships including Facebook, TikTok, and Snap, among others, social media is already a meaningful 9-figure revenue stream for us and is growing at a faster rate than subscription streaming, he said. The music entertainment industry is growing massively, and Tencent continues to increase their revenues, and they have a huge position in the music entertainment industry in China. They currently have over 800 million active users. I really like the social media presence that they have and the moat that they've built. Right now, Tencent Music is trading at around $7.80. The fourth stock is Uxin, ticker UXIN. I have done a few videos on Uxin, the first one being a stock breakdown and analysis, and the other being the fiscal 2022 Q1 report, which came out at the end of September. I would highly recommend you watch those videos as they are much more in depth. Why I like Uxin is because the used car market is very young, and there are predictions that this can be a $300 billion industry in China alone. The government has time and time again stated their commitment to dealing with climate change and backing the used car market. One big thing you can do is to reduce production of new vehicles by circulating used cars over and over again. This reduces the energy to mine and produce the materials, the energy to produce batteries, and many other components in a car. And with the rise of electric vehicles, I expect Uxin to circulate a lot more EVs in the future. They are building their own inventory, and today it is confirmed that Uxin is opening a second superstore as it expands from online to offline. The outlet covers nearly 1,000 square meters, 4 times the size of Uxin's first online superstore. Currently, Uxin has 1,300 vehicles here and can send vehicles like consumers in all regions of China, supporting free returns for 7 days without reason. And these moves are paving the way for Uxin's latest strategy, as the offline chain's UE model, unit economics model, is conducive to increased sales scale and impressive annual gross sales, according to the report. The price right now is currently $2.21. This stock has been going down for quite some time, but I am holding strong because I have really high conviction in the stock long term. This is another stock that I own, and I'm dollar cost averaging as much as possible into the stock. The final stock is Huya, ticker HUYA. I have not done a video on Huya yet, and I will in the future, but right now Huya is a leading live gaming streaming platform in China with a large and active community. They cooperate with esports organizers as well as game developers and publishers to grow their platform. They also extend their content to talent shows, anime, and outdoor activities. Huya is releasing their Q3 results next week, and we'll have to see what the results are, but I look at the online gaming industry today. This article that came out back in May 2021, China Online Gaming Market Report 2021 to 2027. Esports is one of the main reasons for market growth as competitions are broadcasted online. This article states that online games markets in China was valued at $58 billion in 2020 and is expected to reach $86 billion by 2027. Due to the surging popularity of online games in China, companies worldwide are entering the market by acquiring Chinese companies' shares or taking sponsorships of professional players. The popularity of esports is one of the main reasons for the growth of the gaming industry in China, as many players participate in gaming competition that is also broadcasted online. As per this research study, China online gaming industry will grow with a compound annual growth rate of 5.79% during 2020 to 2027. It also states that China is one of the most gainful markets for the gaming industry globally. The online gaming market has appeared as the most influential and transforming segment in China. It has been witnessing a series of developments driven by increasing internet and broadband infiltration, double-digit growth in online gaming users, rapid product development, and commercialization. The rise of Chinese online gamers per capita income has reinforced the China online gaming market significantly. Right now, Huya is currently at $8.38, and this is a stock that is very high on my watch list. These are the 5 Chinese stocks under $10 that I think are undervalued. We have DiDi, ticker DIDI, Fintech, ticker TIGR, Tencent Music, ticker TME, Uxin, ticker UXIN, and Huya, ticker HUYA. These are all companies spanning different industries that are still evolving and have strong future projections in the next decade. These are stocks that are currently leading their industry or will eventually be leaders in the Chinese market, which will eventually become the #1 economic powerhouse, and their middle class is growing like crazy. I have conviction in all these stocks. I'm comfortable in opening positions as well as building the ones I already have. For full disclosure, I own Fintech and Uxin. I don't own DiDi, Tencent Music, or Huya, but I will be eventually opening positions into all of them in due time. If you like this video, please help me out by growing this channel by liking the video, subscribing, and let me know what you think. What Chinese stocks under $10 intrigue you? As always, thank you for tuning in, stay safe, and I will see you all next time.